Hello everyone, thanks for dialing in and welcome to our latest Artemis Live webcast, this time held in association with our kind sponsor Vestoo. Vesttoo is a tech company that uses proprietary artificial intelligence and machine learning solutions to help insurers, brokers and MGAs analyse, assess and transfer risks to the capital markets. You can read more about them using the links in the resources widget you see on the screen in front of you. Today, with the help of some expert panelists, we're going to discuss opportunities to hedge the next pandemic, a highly topical subject right now. But this is specifically using parametric risk transfer facilitated with data and technology, as well as capacity from the capital markets. We're going to explore a product designed to cover P&C losses, but structured with a mortality trigger, with which protection buyers can target coverage for areas of their book where they might lack cover or where cover's now too expensive. And ever since the outbreak of the COVID-19 pandemic, the global reinsurance and retro market has strictly excluded pandemic risks in many cases, leaving few options to protect yourself against losses, including the implications of a lockdown or shutdown of economic activity. So in this Vestoo-sponsored webcast, we'll be discussing the background to this, exploring how data and technology can help to make risk transfer options for pandemic exposure more possible. And so I'm delighted to introduce my very experienced panel today. We've got Yaniv Bertele, CEO of Vestoo. We have James Potter, CEO of Rokstone Underwriting. Luca Tres, Head of Strategic Risk and Capital Life Solutions, EMEA, Guy Carpenter. And David Bearman, CEO of Aventum Group and Chairman of Rokstone Underwriting. So thank you all for joining me, gentlemen. Rather than introduce everyone in depth, I'm going to let their responses do the talking and you'll learn more about them as we go. We've got about an hour, but we'll get right into it now. And just for the audience, if you do want to ask any questions as we go, you should see a Q&A box in front of you. And you can enter into that your questions and we'll get to them towards the end of the session if we have the time. So to begin, we thought it'd be useful to set the scene, explain how the market has reacted to the pandemic and the problem that is now left behind in terms of a lack of coverage for protection buyers of all kinds. James, I thought I'd turn to you first, if that's okay. Could you summarise the problem an exclusionary approach to pandemic risk has left protection buyers facing, please?
Sure. I suppose there's insurance risks that just simply aren't covered by, insurers, reinsurers alike, or, simply it's just too expensive to purchase, especially in the post-pandemic world, which obviously leaves us with increased exposure, to P&C risk, especially when you look at things like event cancellation, credit risk, and, other types of coverages. I suppose when you look at the a parametric solution based on the sort of P&C scenario losses, but if we can sort of look at mortality triggers, it's similar to sort of mortality cat covers, which are very common in our industry. I suppose that these would provide a quick, affordable solution against the pandemic losses, which are otherwise not covered. I suppose unlike regular indemnity coverages, this parametric approach, if you will, doesn't require the insurer to transfer or disclose any of its specific portfolio data. So, the moral hazard is reduced or, completely diminished and brought to a minimum. I suppose that's my take on it, really.
And do you think that the lack of coverage has left problems for buyers at this time? Sorry, that's to you, James.
Absolutely. It's left people sort of wide open, hasn't it? Yeah, sure. It's left people wide open. It's not just reinsurers, insurers, it's governments, countries. It's a global problem which needs sorting. And whether that's a hybrid approach, to having a government backstop, a reinsurance approach, and or a parametric solution, we need to come up with something because this problem isn't going away, is it?
Sure. No, thank you, James. So, Luca, I'm going to turn to you next. And I know you're just settling in on the broking side of things after your recent move. But what are you hearing in terms of appetite for this coverage? Who has a problem and how big a gap is it that we're facing here?
Thank you, Steve, and good morning, good afternoon to everyone, depending on where you are. Your question, Steve, is actually very important, and it has two different sides to it. On one side, the size of the problem. On the other side, who can provide a solution. Problem, we are talking about a massive size. There was already interest in pandemic hedging before COVID-19. The reason why so few transactions have actually seen the surface in the past was simply pricing. Cedants were interested in hedging extreme mortality, pandemic risk, extreme morbidity. The reason why so few transactions have actually happened is simply the fact that the price risk takers were requiring was not met by the other side. So if you put together the previous interest in pandemic hedging together with what COVID-19 made people understand, we are actually talking about a massive interest by cedants, by government, by international authorities to hedge pandemic risk. I was looking recently at some numbers about the economic damage of COVID-19. And if you do the math and work out the lack of growth projected for 2020 and actually the decrease in GDP in 2020 by the IMF, you're talking about roughly 7 points, which translate to roughly 6 trillion of losses globally. Of course, none of us expects that all those trillion will be covered, but if you put together the economic losses in the major countries, you actually end up with a multi-billion cover required. So it's a major challenge for today's economy and for the insurance sector. Now, on to your second part of the question, Steve. In the past, pandemic risk, as well as extreme mortality and extreme morbidity, was actually covered by the reinsurance industry for various reasons. And as we all know, the insurance model works extremely well because of diversification by product and by geography. The problem is, as we all know, pandemic is not local, it's global. Therefore, the decorrelation or lack of correlation play by reinsurance companies doesn't work anymore. Practically, that means that if a major insurance company is covering a pool in Germany, that same pool will take away capacity from another pandemic pool in the US. Result is the reinsurance industry won't be able to cover the need out there alone. That's why you need a new set of participants that come to the market to provide capacity. And that's the key challenge we have here and the key challenge that we will try to solve in the coming months. And I guess we can elaborate on it later.
Great. Thank you, Luca. So, David, the industry's obviously tried to exclude itself out of an immediate problem here with pandemic risk. But then, obviously, we need a level of innovation to help reopen opportunities. Do you expect that to happen here? Do you think the industry is going to respond in the right way to this gap that's emerged?
Yeah. Good afternoon, everyone, or morning, depending on which part of the world you're in. I take a different view on whether the industry has tried to exclude itself out of pandemic risk or whether that risk was obviously deliberately accounted for in the first instance. I mean, let's take a look at the size of the risk we're talking about. You know, a recent OECD publication suggested across 29 of its survey member countries that the economic impact of confinement or lockdown was somewhere in the region of about $1.7 trillion a month. And to Luca's point, you know, a reduction of 6 trillion in GDP, less than 1% of that was actually insured. So, you know, I don't think the industry's taking a stance that it's excluding it now. I think it wasn't designed to include it in the first instance. But, you know, the business interruption gap in this instance is a great concern, of course. And, you know, coming to James's point and Luca's point, there's clearly a solution to a problem here needed. You know, it's been 100 years since the last global pandemic, but our industry obviously has a history of rising to these sort of challenges. And as you can appreciate, with risks that are sort of being perceived to be too big for the sector, you know, how do you go about obviously hedging that or coming up with a solution? And you know, as I say, we do have a history of coming up with solutions to these problems. Cyber is an emerging area of coverage, and obviously where products have been developed. And public-private initiatives have obviously worked very well throughout history, where, for example, Paul Re was set up in result of the Baltic Re bombing in 1993. And similarly, Flood Re has been set up, obviously more recently, to cover what was deemed uninsurable flood risk. These are good examples of obviously covering what is a perceived systemic risk or a risk too big for the market. But I think we similarly will rise to the challenge, if I'm honest with you. I think we'll provide similar arrangements, whether that's via public-private initiatives or whether it's through sort of data intelligence-driven solutions privately. But I do see there forms of products being brought to the market.
Great, thank you, David. Yeah, you make a really good point there that the industry obviously wasn't always intending the coverage that it ends up on the hook for here with pandemic risk. And yes, I think the range of public-private initiatives alongside private market innovation is really the way to solve these sorts of problems. And with that, we'll move on to Yaniv. So at Vestoo, you've been working on solutions to help address the lack of capacity for this type of risk. Perhaps to begin, you could explain why technology and data can help make this more understandable and therefore possible to underwrite with specific boundaries to the exposure.
Thank you, Steve. Hi, everybody. So to start with, I think that the lack of capacity to essentially evolves from the funding gap that is created between the immense need of the liabilities created on the balance sheets of the insurers versus the lack of capacity, if you will, on the total balance sheets combined of the traditional reinsurance. Now, the hardening market associated with specific regulatory scrutiny alongside with variations in the interest rate environments calls for a specific cherry picking, if you will, on the traditional reinsurance side, probably more focusing on what they regard as diversification on their books, leaving aside a significant amount of capacity that is still retained on the balance sheets of the traditional cedents and risks. And for the past 20 years, as Artemis is fully communicating to us all, the growing alternative risk transfer has been focusing very well on the cat risk and opening up substantially the capital markets for the cat risk. However, leaving aside a significant amount of capital on the long and mid-term tails risks that could range both in the P&C in the life domains. I think what we've seen in the pandemic side is the effect of excess mortality on P&C risks and vice versa. And we believe at Vestoo that utilizing technology can bridge the gap by, one, creating an objective, transparent, and accurate language, translating the insurance risks to financial risks, and democratizing, if you will, the ability to buy into those instruments from the usual suspects, the ILS funds, but also diversifying the types of cedents that tap into those instruments, from only the large cedents to the small and medium enterprises, and also enabling a larger amount of peril risks to type into those. Now, with data and machine learning, we believe that we managed to create a common language by, one, educating the credit rating firms to rate additional instruments that do not only embed cat risk, on top of being able to work with the global banks, as we have been hosting a roundtable a couple of weeks ago together with Citi, bringing on board a substantially wider capacity from the traditional financial institutes to buy into those instruments. Now, with that in mind, essentially the risk understanding on the financial side is a key component in educating the broader market on the risk remote nature of specific layers, alongside the uncorrelated nature of those instruments that would diversify the book, if you will, of those financial institutes and enable them to open up for those interesting and risk-rewarding financial instruments. I believe that there should be a process in which third-party independent entities like the accounting firms, the EYs, the KPMGs, the PwCs, etc., the Deloittes, along with the Millimans and the other consultancy firm in those spaces, would be educated on the ability to objectively model the risk, and not necessarily using actuarial tool, but also artificial intelligence tools that would eventually prove the concept of moving from the raw data all the way to a fully understandable expected loss numbers, and hence being able to put in front of those broader financial institutes a seal of approved instrument that has a understandable rated debt instruments or swaps, derivatives that could be accessible to any institutional and accredited investor. So with that in mind, Vesture is tapping into those markets by opening up the ability to cedents to share the data with us, through which we will structure financial instruments to transfer the risk to the capital markets on one hand, and on the other, we're educating third-party independent entities on our risk modeling so that we can eventually deploy those deals with the broader capital markets.
Okay, great. Thanks, Yaniv. So when it comes to a lack of capacity for any type of risk in insurance and reinsurance, we need the industry to think laterally and look at other possible solutions. And it sounds like at Vestoo you're trying to drive that change. In the case of pandemic exposure, there's obviously a lot of talk about data and parametrics and index triggers. And perhaps you could continue to share your thoughts a little bit on the sort of specific solution you've been working on at Vestoo, how you see that working, and also perhaps, and I'm guessing basis risk is something that comes up quite a lot in your conversations, how you're looking to address that as well to make it more understandable while reducing potential tail effects as well.
Right. That is an excellent question. So to start with, what Vestoo has been doing to date is primarily structuring financial derivatives, creating the complementary alternative to traditional reinsurance. And I'm referring to it as complementary alternative, as we are working with the traditional industry. We're working with the brokers, we're working with the reinsurance industries, and essentially structuring the instruments in a way that the risk modeling will be embedded internally on our end, where we act as a one-stop shop and transfer the risk from the insurance space to the capital markets. Now, what we have been faced with during the pandemic are small-sized insurers, MGAs that are not necessarily exposed to excess mortality. But think about cinemas and their insurance companies that all of a sudden have been losses associated with business stop. Now, the question came forth that whether we can provide capacity to the P&C space without necessarily measuring the business stop, rather measuring the losses against an index that would measure, for instance, the excess mortality in the US based on an objective data, for instance, coming from the CDC. And the idea that was developed internally on our end is to take the 2020 numbers associated with the excess mortality in the US in 2020 and compare the 2021 CDC mortality data, creating an index that would have an associated matrix, if you will, of attachment and exhaustion point, and an arbitrary cedant that believes that they want to see capacity provided for their losses measured against those numbers could be provided with as much capacity as they wish, assuming that they understand the objectiveness of the index created based on the CDC. Now, thereof comes the question of if you measure losses associated with the P&C portfolio against the CDC excess mortality data, what happens in between? I mean, essentially the losses on one end are not necessarily linearly correlated to the mortality data. So you can do two things. One is that you enable us to provide you with an additional protection against the basis risk, which essentially is a mathematical measurable amount. That is one option. And the second option is essentially taking into account higher or lower attachment and exhaustion points to get a better correlation, if you will, between what the mortality index will be showing and previous studies of the P&C losses. What Vesttoo, in addition to that, is doing is working on lowering the tail risk by incorporating a commutation mechanism on other transactions that we have, and that is necessarily in order to adapt the shorter duration of time, relatively shorter duration of time that the financial instruments would be appealing to financial institutes, while not necessarily, essentially folding the entire tail of the P&C risk or longevity risk associated with the insurance industry. So essentially we're doing two things. One, if we're doing index-based transactions for MGAs, P&C insurers, or insurance companies that have lack of history, we can do, in addition to that, a basis risk hedge transaction. And if we're doing a longer portfolio-specific risk hedging, we introduce a commutation mechanism to fold in the tail into a shorter duration of time.
Interesting. Sounds like there's been quite a lot of thinking gone into developing this product. James, going to turn to you now. From your point of view, obviously at an MGA, Rokstone, what kind of market participants do you feel could be interested in the type of pandemic hedging solutions Yaniv's described? And is this something you would actually offer yourselves to your clients?
I think there's a variety of people that would be interested in this. Obviously, the major global carriers, Hanover, Munich, Swiss, etc., have huge exposures to this type of risk because, as Luca mentioned, kind of anywhere in the world you're tapping into markets which generally come back to the sort of the major carriers. So I think you've got you'd have an interest from sort of general reinsurers as a whole, because obviously it is a risk to them. Insurers on the direct side. And then obviously it goes out a lot further. You've got obviously governments that are picking up the difference between what is a covered risk, what isn't covered, and just what falls outside. And then obviously just clients, general clients, as we touched on earlier, things like the leisure industry and what have you find themselves in a complete mess at the moment because their policies are saying it's not covered. And again, we come back to my point earlier, the world needs to find solutions to this because it's just something that can't be sustained. I mean, there's probably 10, 11 proposals globally at the moment, sort of seeking, implementation, approval from various bodies, governments, and as Yaniv touched upon, there's various different triggers that can apply to this, but the coverage is a problem, and is sort of taking the world economy, isn't it? Which is a huge issue. As Rokstone, we pride ourselves in being, solution providers. So, we generally sort of come into areas where people are running. So, absolutely, this is something that we'd be, looking to do and explore. And a partnership with someone and a company like Vestoo makes a lot of sense for us, because obviously their technology is something that we've been exploring, and we're speaking some time. So we're always learning, and we learn a lot from Yaniv and his team.
Great, thank you, James. So yeah, I mean, it sounds like there's a need for this at all levels of sort of the risk transfer market, all the different potential buyers out there, which really means that capacity is the key and unlocking that. Luca, before your current role, you were on the ILS side of things in the investment community. Have you seen transactions done in a similar manner to these kinds of hedges for pandemic risks before?
Absolutely, Steve. We have had many discussions and a few deals. And the reason why the hit ratio was low, which same problem applied, by the way, to all ILS funds and to all the reinsurance community, as I mentioned earlier, was pricing. Many cedants in the past, rightly or wrongly, consider this risk as being more theoretical than actually real. So most of the transactions were actually driven by capital management or stress test management. Of course, COVID-19 have changed the picture. So we expect many more transactions to come to the space, but also ignoring the pricing issue. There have been many transactions done in terms of pandemic hedging in the past, mostly by reinsurance companies, as we discussed, but there have also been some transactions done by ILS. The most notable one to remember, as we all know, is probably the World Bank-sponsored pandemic facility. Done in 2016, it had two tranches for a total of roughly $400 million. And it was aiming to solve a problem by making sure that funds were available to people as quickly as possible when needed. The charity model that we all know, the traditional one, is great in the meaning of it, but it has one particular issue. Money gets to the right place when it's too late. The World Bank structured this bond called Pandemic Facility, which wanted to make sure that the funds were reaching the right people upon a pandemic starting. This is why, for example, by memory, April 2020, 195 million of the total bond were actually deployed to 64 countries in the poorest economies. It was fairly complex, to be fair, with many different triggers across geography, across a number of cases, number of deaths. So it was complex, and the press had some negative reaction to it, unjustified in my personal opinion. It was innovative, and I think it did a great job in terms of opening the market to potential future deals of similar nature. Attempts whereby capital market investor can actually add capacity to the space and make sure that we have a sizable and quick solution to a problem that, as we have all seen, will be there in the future again.
Yeah, and that really, again, the capacity seems to be the critical thing here, doesn't it? Having enough to support the reinsurers, who can then support the insurers, and so on down the chain. David, moving to you, what do you find appealing about this kind of product? And perhaps you can talk us through Rokstone's partnership with Vestoo in a little more detail.
Yeah, I mean, the obvious answer to this would be a first mover advantage is an attractive proposition, of course. But, whilst there has been transactions of this nature, the hedging of pandemic risk into sort of capital markets, it hasn't been typical, and it's certainly not mainstream. So clearly, anything where there's an emerging risk and you can tie capital to risk, it's attractive for us as a business if we can develop products. But your point on the World Bank's $400 million bond and deploying 195 million, let's put some in perspective here. It doesn't really touch the sides. The size of the risk is it's just almost unimaginable. You think about US cyclones, economic losses in the last 40 years. There's been somewhere in the region of $1 trillion. So in 40 years, Nat Cat to the US mainland has been $1 trillion versus 1.7 trillion of monthly interruption on a global basis. So the scale is huge, but I still don't think it's insurmountable. I mean, you'd hope, obviously, with a 100-year gap between the last global pandemic and this one, of any note, that there's been huge emphasis by policymakers around pandemic response, obviously, and pandemic plans. So, the future from a pandemic perspective, should we ever be unfortunate enough to be facing one, I think would be different. We've never had to deploy pandemic plans. We've had localized outbreaks on a global basis, but we've never had this thing, obviously, leaving the relative shores of where it broke out. So I think working with someone like Vestoo, obviously, with their analytics and their data capabilities, I think there is a world, as I say, where products can exist of this nature, because you can use obviously index triggers, like Yaniv was pointing out, excess mortality triggers. The difficulty, of course, with those sort of triggers in some countries, of course, is tracking those mortalities and the mortality rates. That's all very well in developed countries, but in those sort of third world countries where you're not being able to truly track them with massive accuracy is a difficulty. But again, one that I think isn't insurmountable. I mean, we developed parametric products for weather protection and index triggers alike. So I don't think this form of coverage is impossible to provide. I think, obviously, from a business perspective, the benefit, of course, is not having to present a claim, not having to go through the proving of a loss, and obviously a fixed trigger limit paying. So there's a huge benefit. We see a great benefit and a great opportunity, but it isn't a simple process.
Sure, thank you, David. Yeah, so we're 30 odd years into the use of parametric triggers, really, perhaps even longer if you look back at some structures that were traded at Lloyd's many years ago. And still people are developing the weather side. So I guess this is going to take time to develop into a proper market, and we all hope that we may not need it. But it's good to see that the development's ongoing. So now perhaps we can move on to talk about some specific opportunities here for buyers and also for sellers. And perhaps, Yaniv, we could turn to you first, and you could explain the type of pandemic events or risks that you feel these products can provide protection for, and also whether the concept can apply to other systemic level risk events.
100%. Thank you. And I'll actually be continuing from what David left, touching on the background, and the ongoing COVID-19 pandemic. The insurers have been facing significant increases in mortality risk exposure, alongside with, of course, event cancellations, business interruptions, travel insurance claims, and more, causing considerable losses throughout the industry. I think the pandemic events have impacted many different lines of business, making it actually challenging to link a certain pool or coverage to a specific settlement mechanism between a cedent and a reinsurer. As such, the benefits of a parametric cover solution greatly outweigh the potential basis risk that we discussed earlier associated with those, where index-based reinsurer or retrocession transactions backed by alternative capital, similar to industry loss warranties that you mentioned before, with parametric triggers linked to excess mortality indices, can provide rapid and effective hedges for pandemic-related losses in the industry. So we're offering cedents the opportunity to buy the protection measured against excess mortality, index based on aggregated deaths in the US. Again, we can extend it to additional countries as a matter of current, we're focusing on the US. And this brings significant set of benefits in terms of cover. The deal definitely is not built on the ceded portfolio. And as David mentioned, there's no portfolio data transferred to the other party selling the cover, eliminating any moral hazard almost completely, and actually enabling small cedents that even doesn't have any historical underwriting or bad performance of underwriting to buy protection. While the deal provides a solution for cedents of all sizes, fully collateralized with no counterparty risk, I think the cost-efficient deal with ultra fast time to market definitely is, at this time is essential. With the objective and transparent indices that are not affected by any changes in regulatory framework. We measure it entirely against the CDC data. And of course, the flexibility in terms of attachment, exhaustion, and capacity size. That's in general. So I think essentially, back to your question, any systemic loss associated with potential events that could be triggered by other parametric events. I'm speaking about cyber, for instance. We've seen attempts to create cyber cover based on other parameters. We believe that eventually we could provide structures to similar transactions. We are actually working currently on an index parametric capacity for the auto insurance in the US, regardless of the pandemic. Think about an index that is created based on NAIC clause, I think it's clause P, not clause, anyhow, the NAIC data associated with motor claims in the US development. So measuring potential index, creating a capacity for an auto or commercial auto insurer in the US without the need to receive any data from the cedent, simply measuring the attachment and exhaustion against the NAIC published data. So there's a lot of options going forward. I think the correlation, however, between the P&C losses associated with the business interruption travel insurance measured against a parametric index that evolves from an objective CDC data, we see a significant traction for it, and we'll be expanding the capacity as we progress.
Great, thank you, Yaniv. And again, capacity comes up. David, turning to you again, obviously the need for cover is clear here, but we really need not just the capital markets, but the insurance and reinsurance market as a whole to respond to this. Do you expect sort of your carrier relationships, do you think they will increasingly provide cover for pandemics going forwards, albeit maybe on a more restrictive basis than it was previously? And do we need these hedging products first, really, to provide the capacity to the higher level reinsurance tiers?
Yeah, thanks, Steve. It's a good question. I mean, my personal opinion is I think we'll see the industry, the wider industry, generally sitting on its hands at the moment. I think we'll see what I think the industry will wait to see what sort of central government response will look like before they develop any sort of pandemic re. And again, not too dissimilar to the likes of Paul Re and Flood Re, where it took a long while to implement. And whilst the idea and the sort of motivation was there, no one wanted to be that first mover. I mean, obviously, there's been a lot of talk, as we know, about this sort of public-private initiative, and with many sort of the industry's figureheads stepping forwards and talking about pandemic re generally. But if you think about what a pandemic is, by definition, it's not just limited to the UK shores or the shores of the US, for example. It's a global issue. And to implement a centralized, coordinated solution is going to be a difficult task, and perhaps a very disjointed one that could take some time. So I actually think that solutions and what Yaniv and Vestoo are talking about are actually probably more viable, and certainly I think would be quicker to market. Where obviously, if you can you're using an index or a mortality trigger to measure that risk with a limit and an exhaustion point, that makes sense. But I think obviously pandemics are going to remain excluded for the foreseeable future, certainly from a reinsurance perspective. And I think the net result of that inevitably is the primary insurers will have very little appetite. So I'm not saying that sort of some of the niche sectors out there won't be able to buy, and I'm certainly sure there's going to be and will continue to be some bespoke transactions placed into the sort of capital markets, I'm sure. But I think there'll be a while before our industry comes up with a mainstream sort of product. So, ourselves, and others working with the likes of Vesttoo, who are sort of leading the charge here, could bring product to market, I think, a lot quicker than the sort of traditional reinsurance market. So that's my.
Great, thank you, David. And James, moving over to you, do you think demand for this type of product is going to continue beyond the current pandemic? Or do you think that it might be slightly reduced if the world gets this fully under control, as we all hope it does?
Again, I think it's probably a 50-50 response here. Obviously, I think there will be a demand. Pandemic was always being discussed, but nobody could ever foresee the scale of COVID-19, and no one could see that sort of event coming, could they? But to be honest, there seems to be a real risk, comprehension deficit within the industry as a whole. So I think it will need to go forward, because obviously I do think there will continue to be this pandemic risk, and if it's not COVID-19, what's the next thing that's going to hit the shores globally? But I think if you've got an innovative parametric insurance product, and certainly the size of the limits that Yaniv is touching on, it may provide an alternative or fill the gaps that traditional indemnity insurance has left us. And also, as David and Yaniv both touched on, without the need to sort of quantify policyholders' loss, claims will be paid quicker. And as David said, it might be a quicker way to market than waiting for governments and insurers to sort of catch up. There was parametric pandemic cover did exist prior to 2020. It was just not understood, and hence it was undersold. And I think a combination of scenarios, i.e. parametric, government-backed, indemnity covers combined, may help to create a hybrid solution. But it does seem to be something that we will be living with, certainly for the foreseeable. And, who knows what's going to be the next pandemic thing that we need to step up and create a solution for.
Great, thank you, James. And I think the sort of multi-layered approach of government, private market, capital markets does seem to be required to really provide something that's going to be a sustainable source of risk transfer for different types of actors in the marketplace. Luca, perhaps you could explain the underwriting opportunity here for risk markets, and why these pandemic hedges could be appealing to capital markets and ILS. And perhaps you could give us a view on what you feel about capacity availability for this type of risk as well, because I know it's been questionable at times in the past.
Yeah, so let me start with the first part of your question, Steve, about the ILS market. Absolutely, the ILS market will play a role here. If you focus on life ILS only, for example, the market I'm more familiar with for obvious reasons, all the main funds have, or most of them at least, have raised money in the last couple of years. The money is there to be deployed at the appropriate return, of course. Plus, there's a number of other funds, they are waiting in the window and ready to jump in the market as soon as they see an opportunity. So funds are available to be invested by the Life ILS community into pandemic products. And if you broaden out to ILS in general, I'm sure also some P&C focused funds will be glad to join the opportunity at the appropriate return. One point needs to be mentioned though, when we talk about ILS and pandemic risk. A good number of investors that back up ILS funds invest in ILS because they want to have an uncorrelated return. And by investing in pandemic, the lack of correlation is not there anymore, at least in theory. We have seen what has happened in 2020, and you can argue that it was somewhat correlated if you look at equity, for instance. But in theory, pandemic is correlated to returns in equity and fixed income. And that can be a problem for some of the investors behind ILS funds. But there's one point that, if I had to pick one, I want to make sure that the audience gets away from me today, which is the one that the aim of the game here, guys, is to broaden the scope of investor in pandemic. As Yaniv mentioned many times, and we actually agreed to this point, on this point many times in the past. The aim of the game is making sure that the wider capital markets with much deeper pockets will enter the space and bring the capacity that we need. There's no way that the reinsurance community and the Life ILS community or ILS community in general will be able to provide a material enough solution to the problem. We need to educate investors outside the traditional ones about this opportunity and making sure they play a key role to solve the problem. And by the way, out there's a massive interest in ESG investments. And by definition, pandemic hedging is ESG friendly. So the aim of the game on our side, on Yaniv's side, and everyone, is to make sure that we find investors that are sophisticated enough and have not looked at insurance risk before, and they are happy to put their deep pockets into proper use at the appropriate return, of course, and making sure that their capabilities will serve the goal, which is providing a material enough and sizable enough solution to the challenge. And frankly, if not now, when?
Good point, Luca. Yes, if the industry can't respond to an ongoing problem that we have today, then really it's not meeting what we would expect of it, let alone what customers of insurance companies would expect from it. So we're now at about 12 minutes to go. So I think we'll move to a few of the audience's questions, if that's okay with the panelists. I have a specific one on Solvency II. I'm not really sure who to direct this to, but actually, Luca, I might try you first because you may have a view on this. How do you see these kinds of instruments fitting in the Solvency II world? And how would they reduce capital for either life or P&C insurers?
So it's a very important topical question, actually, because if I go back to my earlier point, most of the structure done in the past on extreme mortality, extreme morbidity in pandemic were actually targeting a capital management benefit. Now, Solvency II is complex, as we all know, and you don't have a straightforward answer in many cases. But I tell you something. If the risk transfer is material enough, you get the benefit. So it all boils down to attachment and detachment point. Perspective, or you can look at it from other perspective. If the question was more referred to the instrument, i.e. index and maybe a derivative as opposed to an indemnity reinsurance, there's a plethora of transactions that can be used as an example that have been done in the past. Derivatives are fully allowed as a risk transfer mean by Solvency II. If you look at Solvency II text, there's actually a well-written part about derivatives as a way to transfer risk, also financial and also non-financial, therefore insurance risk. And so you can use them. And on the indemnity or lack of indemnity cover, i.e. the use of the index, this is not new as a problem. As Yaniv knows from our previous discussions, the same problem has applied in the past to longevity hedge, when people try to use an index as opposed to an indemnity hedge. And Solvency II says very bluntly that if you can prove that the hedge is effective enough, the hedge is valid from a Solvency II standpoint. And what you do practically is you take data from the past, and 2020 is, of course, sadly, a great year to use for the perspective, and show that the correlation between the hedge you want to put in place and the losses is actually high enough to make a difference. So, summarizing, as long as the risk transfer is material enough, and as long as you can prove that the correlation between the index and the losses in your book is high enough, Solvency II tells you that you can get the benefit.
Great, thank you, Luca. That was a really good answer and very comprehensive, so I hope that helped the person who asked that question. Yaniv, we have a question directly for you here. How is Vesttoo's modelling different, or how is it similar, I suppose, as well, to traditional actuarial work undertaken by the big firms out there? So I guess, could you talk a little bit about some of the base technology that you're using at Vesttoo?
Yeah, well, that's directly in the core of our business. So the company decided that in order to transfer risk in an objective and accurate manner, you need a technology that would not have any associated expert judgment, which means that we need to work with raw data to start with and fully model the risk on a machine learning process that would eventually not have any human intervention attached to it. So Vestoo works and models the risk based on proprietary artificial intelligence technology that essentially works in two stages. And I'll get slightly more technical here. We work in a first stage in which the raw data coming from the historical performance of the ceded portfolio or the industry is fed into a large number of models, hundreds of models that are now competing in providing the highest score of prediction probability. Now, the machine looks on the large set of models and provides each of which a scoring associated with their prediction capabilities, and the winner receives the prize of independently modeling that specific portfolio liability index. And that specific risk modeling would become the management tool of that specific transaction, projecting where the risk will be developing eventually over time associated with the attachment and exhaustion points we will be associating the expected losses into. Now, taking into account that the process was done bottom up from the raw data, you haven't affected it with any expert judgment. You now have a pure objective machine interpretation of where the inherent portfolio risk will be going over time, assuming from a mathematical statistical perspective, you can educate on the process. You now have an objective tool that can project where the risk is developing. The second stage is to prove the accuracy of the objective nature of the technology, and this is done by backtesting methodologies, etc. One more key point to bear in mind, most of the machine learning approaches has been taking the stochastic extraction process of taking historical data and modeling it further in time. What we do is blend into the equations not only stochastic tools, but also inflation-based parameters that inject some more noise into the data, which essentially provides us the ability to take into account not only historical performance, but also unpredicted elements associated with the results, like pandemics, like regulatory, environmental changes, etc. So the idea is to create an objective yet accurate and measurable tool that would serve as the underlying tool for the risk transfer without selling the technology, using it internally to transact, which now enables us to put in front of the capital markets, as Luca indicated, a tool that any investor could be educated and understand that would eventually help to broaden the capital markets participation in those instruments.
Great, thank you, Yaniv. So we've got a question here on a topic that actually, David, you mentioned. I think it was you who mentioned Pool Re earlier. Somebody's asking, do you think it's feasible for the UK government to authorise Pool Re to additionally accept pandemic premium moving forwards to, I guess, increase Pool Re held funds and enable them to offer more capacity, but also potentially buy more retrocession as well for themselves to become a source of pandemic protection? And David, would you like to try and answer that one?
Yeah, sure. Thanks, Steve. It's a good question. Pool Re, as we know, was set up to cover, obviously, the terrorism risk. And there has been talk of Pool Re assuming the risk of pandemic, obviously, for the UK government. But Pool Re is, whilst it's a public initiative, it's actually backed by private capacity and ILS, ironically. So it's a question of whether that structure can allow pandemic risk as an additional coverage within that structure. I think in all likelihood, you'll probably see, if it is the intent with a private public initiative, of a pandemic re almost set up specifically for pandemic risk, separate to Pool Re, covering separate risk with separate retrocessional programs, obviously into the private market and potentially into the capital markets. But I come back to the point that I see that initiative as taking some time, and therefore I see the advance and the first mover advantage with the likes of Vestoo and their technology and access to capital markets as being quite significant. So yeah, never say never. By the way, Pool Re might change its obviously its structure and therefore assume that risk quicker than we'd anticipate and most will want. So. But I actually see specifically, if anything, a standalone or a separate entity being set up like Flood Re, with separate programs accessing, as I say, potentially private and public money.
Great, thank you, David. So I think we've got time probably to take one final question, and I'm actually going to link together a couple of questions here, and I'm going to throw this to you, Luca, I'm afraid, for another view. If a global pandemic's systemic, if it violates potentially the principles of diversification occurring 1 in 100 years, what might a capital market or reinsurance industry participant need to charge for taking that risk on?
So, Steve, I have a policy which I painfully learned to apply. Never put a number until you see actually the risk of the transaction. So I won't put a number to the cost of the transaction now. But as I mentioned earlier, Steve, I have seen in the past at least 10 extreme mortality projects a year in the last 10 years. And out of those 10 a year, probably one or none actually traded because of pricing. Cedants were not willing to pay up what reinsurers and ILS funds wanted. Now, of course, everyone realized that pandemic risk is not just a model, it's actually a real risk. We have all seen it. Therefore, I would expect that pricing gap to narrow a little bit. What worries me, and I'm being very open and frank here, is that when cedants will actually see the pricing that reinsurers will accept, they will think, you know what, we had our pandemic last year, it won't happen again for another 100 years, so I won't pay for it. That is the point that actually worries me most.
Yeah.
We will see, in my opinion, of course, a massive increase in pandemic hedging costs compared to the past, for obvious reasons. But this time, because of the involvement of government-sponsored vehicles like Pulri and many others, because of the interest that is now finally there on pandemic risk, and maybe through tranching of the different layers of pandemic risk, I think we have actually a real chance to make it happen. I see a chance that finally cedants and risk takers will find the middle point where pricing will work for both parties.
Great. Thank you, Luca. Thank you very much. Yaniv, just going to turn to you very briefly, given that you're the kind sponsors of this webcast. So with this new product, have you got any feel for when we should expect to be writing about a completed transaction?
Well, what
are your hopes?
We are negotiating several transactions already. We have the capital markets lined up in terms of interest, and we're discussing this with several cedants in the US in the P&C domain. So I assume you will be hearing about it in the next couple of weeks to months.
Great, thank you, Yaniv, and I look forward to getting those press releases and getting to write about these new and innovative transactions. So look, that's all we've got time for today. I just want to thank all of the audience for dialing in and remind them that if you came in halfway through, there will be a on-demand link sent to you all after this so that you can watch it again or complete watching it at your leisure. So thank you again to Vesttoo for sponsoring this event. Thank you, Yaniv, for participating. Thank you to James Potter, CEO of Rokstone Underwriting. Thank you to Luca Tres, Head of Strategic Risk and Capital Life Solutions, EMEA at Guy Carpenter. And thank you very much to David Bearman, CEO of Aventum Group and Chairman Rokstone Underwriting. I really appreciate you all taking part. And thank you to everyone who was watching today.
Thank you, Steve. Thank you very much.
Thanks, Steve. Thanks all.
Thank you, everyone.